You are listening to the Go Get Them show. This is a discussion that inspires entrepreneurs to pursue their passion to create meaningful, impactful, and sustainable companies in Asia, Africa, and Latin America. This is your host, Arun Krishnakumar, together with my co-hosts, Maxon T. and Sheila Mburu. We sit down with entrepreneurs, operators, and investors across frontier markets to discover their experiences, lessons learned, and how they make an impact so you can too.
No, and of course, it's interesting. So I was born and raised in the Bahamas. And when it was time to go to college.
We do pre-A, getting back to your question. It is heavily a strategy that's a little bit more unique. We do about call it one of those a year.
For this episode, we have a very special guest. We have Stevon Darling. For those who do not know, Stevon Darling is the Lat Am focused venture capital investor at IFC, the International Finance Corporation, a World Bank Group member, the largest global development institution focused exclusively on private sector in developing countries. IFC invests in innovative early-stage technology companies in many sectors, including health, logistics, mobility, fintech, internet, and B2B sales. IFC has a fantastic portfolio, including Loggi in Brazil, Lifted, Colombia, Clínicas del Azúcar in Mexico, Confico in Mexico, Bolt, Byjus, Coursera, Red Doors, eFishery, Moglix, and many more. IFC are also investing in venture funds such as 400 Startups, Early Bird Ventures, Jungle Ventures, Wavemaker, Partech Ventures, Samayaka, and more. So Stevon started his career at Goldman Sachs before joining IFC as an emerging market investor. He spent 3 years investing in equity and debt projects in emerging markets, including Latin America, the Caribbean, the Sub-Saharan Africa, conducting financial business and market diligence, monitoring over 400 million of projects by building financial models, conducting global market research, and more. Stevon holds an MBA from Harvard Business School and a Bachelor's of Arts from Accounting from Morehouse College. Thank you very much for joining us today, Stevon. Welcome to the show.
Thanks for having me, Max. Arun. Glad to be here and looking forward to the conversation.
So I'll start off with the first question. What's the pivotal point in your career, right? If it's okay, I'd love to hear your fantastic career. It sounds like you've done a lot of great deals. So we'd love to learn a little bit more. What are some of the pivotal points in your career?
No, and of course, it's interesting. So I was born and raised in the Bahamas. And when it was time to go to college, I looked at my peers. And when you're growing up in a small place like the Bahamas, there are pretty much two types of industries where folks want to go into. Either you want to go into the law, or secondly, he wants to go into medicine. So being a young, naive 16, 17-year-old at that time, I thought that I was going to be a cardiovascular surgeon. So moved to the US, did undergrad at Morehouse. And by the end of my first year of pre-med, I realized that although I was doing pretty good in my studies, there was a huge lack of passion. And when I fast forward to today and I think about what happens to allow me to learn more about finance, I think it really is a remarkable journey about how technology can be useful in so many different aspects. So to give you a very interesting story, I found myself one day after a long day of labs, decided to take a break from studying. And like most college students, I went on to Facebook. And on Facebook, I, for some reason, was given a ad for a 3-day course in New York with JP Morgan to learn more about investment banking. Applied, thought it was an incredibly long shot for someone who was a pre-med to get accepted into this banking program. But interestingly enough, I was accepted. Was able to go to New York for 3 days, my first time in the city. And I was completely blown away by the way that finance has the ability to change lives on so many levels. One, from the aspect of giving large, successful companies an opportunity to expand into new markets, but also allowing new startups to be able to grasp and take advantage of new market opportunities as well. And so after that 3-day program, I returned to school and immediately changed my major. And I think that really set me on the course that where I am to today. Um, so, after school, when I decided to go to Goldman, at that point, I knew that I wanted to figure out an opportunity for me to combine my interest in finance with my interest in emerging markets. Something that was always incredibly important to me growing up from a small nation state like the Bahamas, which has only around 350,000 people, is trying to figure out how could I do something to give back to the country that essentially allowed me to become what I am to today. And one thing that I found through my years at Goldman is this huge gap of finance that exists between the developed world and emerging markets. So for me, Goldman was always a stepping stone for me to build a very strong base in financial analysis that I can then use that to focus on what I believe is my true passion is emerging market finance. So very fortunate to be with IFC at the moment where I lead our direct investments in startups in Latin America. And so far, it has been a great opportunity for me to take advantage of what I had set out to do.
Let me go next. Um, Steven, I have to understand how you actually made the transition between Goldman Sachs and IFC happen. It's a completely different world, isn't it? You have the cutthroat investment banking world, and then you have IFC, which puts impact ahead of even business viability in some sense. Of course, both are important. So, how did you make the transition between these kind of public market investments and private sector venture capital investments?
No, and of course. And then I think there are several differences for me. I think one of the basic differences that I encounter for my work today at IFC versus what I did at Goldman, I think right now there's a much higher level of risk as well as ownership. Whereas at IFC, we're investing off of our own balance sheet in companies that are much earlier stage where potentially less than 30-40% of startups actually survive, and a much lower number of those companies have a successful exit that is financially successful for investors. And when I think about what I did at Goldman on the investment banking side of advising companies which were much later stage, much larger, and much more secure from a financial standing standpoint. I think the level of risk was much lower, which also impacts how we thought about diligence. Um, I think also a big difference in terms of the diligence for today at IFC versus at Goldman is while we did occasionally look at emerging market investments at Goldman, a lot of the advisory and financing we did were for some of the largest countries in the world. So did a lot of work in North America, a lot of work in India, a lot of work in Hong Kong. And when you think about those markets, there is a plethora of research that is available for a number of different types of segments. And so if you want to learn more about the smart metering sector, 9 times out of 10, you can go online and find a number of news articles, or you can subscribe to a large bank's research reports and get very significant levels of information. But you think about what I do now in terms of trying to invest in very nascent industries in Brazil, Mexico, and Colombia, a lot of the research that we are doing is very local and on the ground. To give you a good example of that, in 2018, we led the Series A round of Lift It, as Max mentioned, which is a last mile provider in Spanish speaking Latin America, delivering packages both on the e-commerce side as well as packages from, call it a warehouse to a storefront for some of the largest conglomerates in the region. Um, and for us to get comfortable with the thesis of this business, it really required for us to go on the ground, speak with truck drivers, speak with the customers in order to truly understand one, if the market is large enough to sustain a venture capital investment, and also to understand what the competitive landscape looks like. So I think that's one big difference in terms of getting your hands dirty, so to speak, and truly being local in terms of your due diligence process. I think the second aspect of a huge difference between then and now is our diligence is much more collaborative. When you think about investment banks, it's oftentimes very competitive when these organizations are trying to win advisory products versus on the VC world, specifically from the context of the IFC, where we want to be seen as mobilizing capital versus crowding out capital. For us, it's oftentimes important to speak with other venture capitalists on the ground to one, share what our thesis is, but also get a better understanding of how they see the market. And so it's a much higher level of collaboration with other VCs, either early stage than where we invest, or who invest at the same stage in order for us to develop a comprehensive thesis to guide our investment decision.
Great. So the other question I always have, and I face this on an everyday basis at work, there is always this tension between kind of demonstrating that a business is viable. But there is also the other side of things, particularly in the development finance world, where there's a need to demonstrate strong social impact. So how do you make sure that firms that come to you have that balanced one? And what is more important to you? What is the priority in your view? Is it impact first and then business viability next, or business viability and growth opportunities? And as long as there is some kind of impact, you're good to go. So how do you position your investments, and how do you choose your investments across these dimensions?
Yeah, so for us at IFC, impact obviously is something that is incredibly important. Being a part of the World Bank Group, we see ourselves as trying to invest in private businesses in emerging markets in order to bring to life the twin goals of the World Bank, which essentially is to reduce the level of poverty that exists in the world and also to ensure that there's more equality as well. In order for us to do that, we have to invest in companies that are going to have a strong financial return so that we can make a huge statement and stamp of approval for impact investing so that other commercial investors can see these sectors and these industries as being worthwhile for them to try to get exposure as well. And so when we think about an investment, we really try to think about it through both lenses. Firstly, from a very commercial standpoint, does this deal check all of the boxes to ensure that within 5 to 7 years we're going to have venture-like returns? And then after we have decided whether that's going to be a yes or no, trying to understand what's the level of social impact. At IFC, we have an entire team of an analyst who focus solely on identifying and quantifying the level of developmental impact. But also, I think for us, by being emerging market investors, we have the benefit of investing in a region where there's such a huge level of gap between what you see in this part of the world versus the US, that almost everything that we have an ability to look at can be classified as impact. So you think about what we have done investing in companies such as Coursera and other edtech companies such as Creana in Latin America, and the ability for anyone to log online, develop a new skill set, and then apply that in their day to day to get a new job, improve their standard of living, get a higher level of salary. I think that is a very strong level of impact that transcends across the board. When you think about what we've done with, call it last mile delivery, which empowers e-commerce. On the face level, one may think there's no impact there, but you think about the folks who are really powering the delivery of these businesses, 9 times out of 10, they are um, parts of the low income population in these markets, some of the most economically vulnerable parts of society, who now have visibility in terms of what their income is going to look like. And because of these platforms, they have, quote unquote, a full, call it 9 to 5, 7 day work schedule, which is truly changing the lives, not just of them, but of their families as well.
Thank you so much for sharing that, Stevon. I really love the way you construct I guess the balance between profit and impact. And I guess my question is, double clicking a little bit, right? So, what is the investment process like in order to achieve the outcome that you have talked about, which is profit and impact, right? So, talk us through a little bit, how do you source deals, how do you due diligence deal, and ultimately how do you support the deal and make sure they address some of the impact and profit goal that you have in mind?
Yeah, of course. So I think for us at the IFC, when we think about investing in a business, we have a two-step process. So to give an example, if a company were to come to us today for investments, during the first few days, part of the conversations that we're having with the founder and his or her management team is around the business model, the vision, projections, but also part of that is us trying to understand whether there is developmental impact or not. Um, if we do believe that there is developmental impact, then potentially 2 weeks after that first meeting, you would go to the first step of our investment committee approval process. During that conversation, it's usually around 25 to 30 minutes where we're discussing all of the aspects that are important to IFC. One of them, which is focused on social and economic developmental impact. And early on, folks who's is highly focused on this part of our investment thesis has a seat at the table. And so if it's deemed at that point that the developmental angle is not strong, then we would go back to the founder and explain that we're unable to move forward because of several reasons. Um, if that were to happen, I think there are many other ways that we can try to support the entrepreneur and her or his business. I think one, IFC in many different emerging markets, we've invested in a number of venture capital funds. So when you think about some of the leading funds in Latin America, whether it's Mountain Nazca in Mexico, Valor in Brazil, Monashis in Brazil, NXTP, or Kazakh, we have a very close relationship with them where we have a two-way method of sharing pipeline. And so oftentimes, if a company does not fit our thesis, but we still believe in the financial merit of that business, then we have the ability to pass that deal on to one of the funds where we've invested or one of the other many funds where we have a very strong relationship. I think the second way that we still try to help companies who may not have a strong developmental impact to fit IFC's thesis, but we still believe in the mission, is we find ways where we can take that startup and make commercial introductions to one of the companies that are in IFC's portfolio. So oftentimes, IFC invest in a number of very mature companies that startups are trying to sell to on a daily basis. And I think that's one of the strong value adds that we have as IFC. That network is not just reserved to companies that are in our portfolio or companies that we're trying to get exposure to, but oftentimes, if a company isn't a good fit for our thesis, but we still believe in it, there's an opportunity for us to make connections there as well.
Thanks for that, Stephen. I have to ask this because I've always felt that when it comes to investing into the venture ecosystem or the venture into venture firms, venture capital as a subset of the investment community have done really well. They've made themselves very accessible. They've almost published what they expect out of these venture firms to get funding. Whereas I often find that DFIs are haven't been that good at marketing themselves to the startups. I wouldn't say that for IFC. IFC probably is an exception. You managed to get into the wave round, a 200 million Series A of a fintech company in Africa, where you had Founders Fund and Sequoia, and you managed to get into that round as well. So I would love to understand what your secret sauce is in to get into these kind of big rounds. But what do you think in a much more overarching sense? What do you think that the development finance world need to do better in engaging with the startup community?
Yeah, so I think a number of things. I think on the one hand, we have been fortunate over the last 10 years to have been invited into um, some of the most fast growing startups in emerging markets. But I think at the same time, there's also a lot of stigma that's attached to getting money from developmental institutions. I think on the one hand, a lot of DFIs have a reputation for having much longer processes versus truly commercial investors. I think the case is the same for the VC asset class. And I think there are a number of structural reasons that cause those differences. When you think about a venture fund, the majority of the times, folks are making decisions are really two or three folks on the investment committee who are also the GP as well. And so it's much quicker for a true VC to make a decision versus an organization like the IFC, where we're essentially managing money for taxpayers around the world. And so there, by definition, has to be a number of touch points that are built in to ensure that we are being as best fiduciary stewards to the capital of citizens in many different markets. I think that's point one that can be a bit of an obstacle, especially in a climate today where there are so many new emerging market investors who are waking up to the opportunity to make very significant returns in the venture asset class. When I think about Latin America, where I spend the majority of my time, in the first 6 months of this year, more than $6 billion has been deployed to VC investors. This is compared to around, call it 4.2 million that was invested in all of 2020, and roughly around 4.9 billion that was invested in all of 2019. So there is definitely a huge influx of capital that's coming into select emerging markets, which is making it a lot more competitive. And I think two ways that a lot of VC funds who are not local investors try to win deals. It's one, by being as quick as possible so that founders do not have to spend significant amounts of time dedicated to the fundraising, which takes away time from operating their business. And also a second lever that they have to play with is around valuation. So I think that has caused a bit of difficulty for DFIs to get exposure to certain deals. But I think for certain founders who do understand that when you are looking for capital, it's much better to have a diversified capital structure versus focusing on one type of investor. I think we tend to do much better with those deals because it's a much better fit for what we are trying to establish. I think those founders truly understand that different types of investors have different strengths, And if you want to take a company and scale them as quickly from point A to point B, understanding how you can tap into all of those different types of investors to create value for your shareholders and for your customers is potentially the most prudent way to move forward. And I think for those types of founders, we tend to do very well, and I would assume that other DFIs would do well also.
Thank you for sharing that, Stefan. That was really really good. I guess then from my perspective, let's say I'm a founder, and I would like to build a new company. And what would you say to me that you're most excited about, right? So basically, a request for information around some sort of venture ecosystem, right? What are you most excited about in in Latin America venture ecosystem? If you could, share a few examples with us, right? Some of the impact that you've seen, and how do you see the venture ecosystem going forward? I guess bear in mind, just from an entrepreneur perspective, what are some of the things that you could get us start moving and building for impact and profit?
For me, I think potentially two things come to mind. I think that what we're seeing right now is a higher level of sophistication in terms of the types of businesses that are being created in Latin America and other emerging markets. I think that is a direct result of when you think about the first degree of innovation, people typically think about what are the low hanging fruits. And I don't say that in a bad way to take away from the great work that entrepreneurs have done. But oftentimes, these problems are much more apparent to would be entrepreneurs. So when you think about the fintech industry, the first wave of entrepreneurship, what we're seeing today in Latin America has to do with digital banking, it has to do with payments, it has to do with wallets. When you think about the e-commerce and the logistics sector, the first or second wave of entrepreneurship had to do with last mile delivery. So just how do I get a package from point A to point B as efficiently as possible? You're seeing companies such as Nouveau Shop, who is creating the Shopify of Latin America. It's all focused about how do I take the hundreds of thousands of SMEs that don't have an online storefront to be as digitalized as possible. I think that in those first wave of startups, we're beginning to see de facto winners, and there is a very limited ability for newcomers to come in and innovate, barring some new type of technology or new type of product that is significantly more efficient than what we have today. And so I think that's causing a lot of new founders are thinking a bit deeper about how do I create the second or third wave of software that potentially is creating back of the office solution to power these industries. So when you think about the logistics sectors, we're now seeing a number of folks who are trying to create telematics plays, folks who are creating software specifically for routing, folks who are trying to create software for warehouse and manufacturing automation. So I think in a lot of emerging markets, you're going to start to see more of that second and third wave of startups who are going much more deeper in terms of creating that quote unquote back of the office solutions. I think on the second theme that is really significant for us and that we're seeing a lot in a number of the markets where we operate is that there are a number of companies who are focused on productivity and efficiency gains for small and medium-sized businesses. I think that transcends to B2B marketplaces. So in markets like Latin America, there are companies such as Cheaper, which focuses on creating B2B e-commerce for mom and pop shop grocery stores. You have companies like Ruana that is focused on doing something similar for the supply chain of restaurants. IFC has also made a number of investments in the space in other markets such as Twiga in Africa. We've invested in Coursera in Southeast Asia. And so I think that is a trend that's going to continue to happen. But also, I think in terms of the SME product set, you're also seeing a significant level of digitalization platforms. So, we have invested in a business out of Brazil called Archivate, which essentially focuses on storing e-invoices in Brazil to allow both SMEs as well as enterprises to comply with local regulation where you need to store e-invoices for at least 5 years. What a lot of companies such as Archivate, who are creating platform businesses, are realizing is that once you are able to secure a significant level of users on your platform, then there are tons of other ways that you can begin to monetize your solution. So in the case of Archivate, they now have around 15% of all of the e-invoices that are traded in Brazil on their platform, which opens up a number of doors. One, to provide information to third party banks in terms of factoring. Secondly, in terms of helping both SMEs and enterprises to understand what their market share looks like in different parts of the country. And I think the list goes on and on. And we've seen other types of platform businesses in other sectors who also have the ability to tap into this very attractive resource that they have. I think the third trend that we're seeing, at least in Latin America, is a number of early stage funds are beginning to create so-called opportunity funds in order to invest in later stage rounds of their early stage portfolio, and also to invest in later stage rounds of companies that they don't currently have exposure to. In a market such as Latin America, I think that's very important because there still is a very large gap when it comes to growth equity financing. And so by creating these opportunity funds, you're able to help meet demand for this stage of financing. But also, I think these fund managers are realizing that there is a lot of continued growth that companies can have when they're at the Series C and Series D stage that can also provide a very attractive return to certain types of LPs. And so in this way, they are doing their part to fill the funding gap, but also they're ensuring that they have an ability to enhance the returns that their LPs are looking for.
Thanks very much, Seven. And just to close off the conversation, one final question, if that's okay with you. Where do you see venture investing going from here, particularly in emerging markets? I know you're very focused on Latin America, but what do you say? What kind of problems do you see venture capital? What is that addressing? Would be really good to understand that.
Yeah, sure. I'll use Latin America as an example, since that's the region where I know best. So when you think about the amount of capital that went into the region, call it between 2015 and 2017, in an aggregate basis, that potentially was no more than $500 million. Now we have, in the first 6 months of 2021, $6 billion of capital that is being invested in the region. And so I think investors are waking up to the potential to make very significant levels of returns in the venture asset class. I think beyond that, the types of investors who are getting excited about the market also speaks to how far we have come. There are a number of corporate venture arms that are popping up throughout the region, which is a result of very large conglomerates, which oftentimes are very old school and not ahead of the trends, waking up and understanding that oftentimes if they do want to remain competitive, then there's potentially no better way to do that than to invest in an early stage startup to understand what technological trends look like and potentially invest and acquire innovation versus trying to build that in-house. I think also along those lines, we're seeing a number of local funds who are able to raise much larger pools of capital. So when you think historically in the Latin American context, not just for VC in investing, oftentimes Latin America had to depend on investment capital from the US, potentially Europe, or other developed markets, which is great in the good times, but really bad in downsides of the economic cycle because FDI is typically the first type of capital to dry up and the bottom part of an economic cycle. And so having local investors who truly understand the level of cyclicality that exists in these markets could potentially ensure that venture capital funding is more stable throughout the years. And then I think about another positive trend that I have seen that speaks to the development of the market is one of our venture funds in Mexico recently did a study to try to assess how do university students think about career opportunities. And in 2020 was one of the first years where the majority of graduates were thinking about working for a startup versus a more traditional path, such as a consultancy, an investment bank, or working for a Fortune 500 company. And so the level of risk that university graduates are beginning to take to get exposure to fast growing startups is also accelerating the growth of the industry. Because oftentimes what we see is once very smart students go and work for a startup, then after a few years, they're motivated to create their own business, which then multiplies the types of startups we have in the industry. When I think about things that we're still missing, I think growth equity still needs to be solved in the region. Um, Part of that is being solved where you see local private equity funds who are moving down market to get exposure. But we're still not anywhere where we need to be. I think a second item on my wish list in order to transform Latin America to what we're seeing in the US is around access to venture debt. I think there's still far too little players who are focused on that asset class. And then I think the third point for me is while on the one hand, we can say that capital is becoming a bit more democratic in Latin America because there are higher inflows of capital. I think the democratization of access to capital is still only reserved for a select few in many emerging markets. A select few who potentially went to the highest ranked universities in Latin America, or who may have had the opportunity to go to the US or Europe for educational training. It's also oftentimes really reserved for folks who are in the large capitals or the large cities of Latin America other emerging markets. But when I think about so many companies in the US that were founded by folks who may have not even gone to university, or folks who may not have had access to some of the best networks in their countries. I think that's where we need to get to. Because one thing that we have seen throughout investing in the venture asset class over the last 10 years is VC not only has the opportunity to change lives for customers, but also it has the opportunity to change lives for generations of founders and their communities. And I think the point when in Latin America, we truly would be able to say that we have progressed 100% in terms of the democratization of the industry is when there will be more women who are getting financing, more minorities in the region who are getting financing, and also more people who come from a lower socioeconomic background who are able to get financing to start businesses as well.
Cool. Thank you so much for sharing with us. We're coming to an end to our episode. Thank you so much again, Stevon, for joining us, for sharing such insights with us. I guess one last thing for everyone, for those who want to learn more about Stevon, you can check him out on LinkedIn, Twitter. He's pretty active, and definitely try to reach out if you're building something really cool in the impact space, especially in the Latin America venture ecosystem. Thank you very much.
No, thank you both for having me on. I really enjoyed it.